Federal Reserve holding its large bank capital conference today, focused on regulatory and oversight reform. Leslie Picker joins us with Federal Reserve Vice Chair of Supervision, Michelle Bowman. Good morning, Leslie.
Hi, good morning, Andrew. Thank you. And Mickey, thank you very much for being here. It's a big day for you. Just 6 weeks into the role, you've moved very quickly with a slew of proposed deregulatory actions. And the level of capitalization at the banks is kind of a function of, it's a balance between economic growth and the safety of the banking system. So was there something in the macro backdrop that compelled you to make this slew of changes?
Well, I think we realized that we're 15 years past the financial crisis and the implementation of the Dodd-Frank regulations, and that it's time for us to take a look backwards to understand what's been working, what isn't working, what's duplicative and overlapping, and how we could have a more comprehensive review of what those, especially the capital regulations are, which is the whole focus for today's conference, and how we can have a much more rational, much less duplicative, less overlapping framework for banks, for the large banks, to comply with capital.
Was there something you felt like was holding back the banking system? I ask only because they just reported earnings and they were kind of, knocked it out of the park, profitability-wise. Did you feel like they were being held back in a way that was still, harming economic growth?
No, actually, I think that the capital framework is something that we've been engaged in and had committed to changing. We have several pending regulations like Basel III. We have a GSIB surcharge proposal that's been pending for over a year now. And then we've also committed to improving our stress test regulations and that process. So as a part of reviewing all of those in context, we wanted to make sure that if you make changes to one of those individual regulations, that we want to make sure that they all work together, because there is such overlap and interaction between those four pieces of capital. So we wanted to make sure that we had the opportunity to, one, understand what all of those expectations are, and two, make sure that as we're recalibrating some of them, that we arrive at the right level of capital for the system as a whole.
Do you feel like you have consensus among your peers in achieving this agenda? Do you have everybody on board with you?
So we're working very closely together, especially within the interagency context, because many of the rules that we'll be talking about today require an interagency agreement. But we also are working very closely, and I think you'll see from many of the proposals that we put forward that we have broad consensus from the board on some of the changes that we've been making.
Michael Barr, your predecessor, he gave a speech last week where he said, quote, weakening regulation often drives risk-taking and increases bank fragility during the boom, meaning kind of the boom times, making the ensuing bust more painful. In other words, he's basically suggesting that deregulating during times of strength can have worse outcomes down the road. Is that a concern of yours?
Well, I wouldn't call my approach deregulation. What I think we're looking at is making sure that the regulatory framework is appropriate for where we are in the system now. We've more than doubled the level of capital and liquidity in the system since the 2010s. And so I think now is the right time for us to understand what works, how we could improve the framework, how we could make it more transparent and more interactive so that it works together in a way that makes sense.
We've seen a slew of headlines over the last few weeks raising questions about the Fed's independence. President Trump, taking aim at Fed Chair Powell. Are you concerned at all about the threat to Fed independence right now?
Well, it's very important, and I've said this a number of times in the past, that we maintain our independence with respect to monetary policy. I think that's very clear. But we also, as a part of that independence, have an obligation for transparency and accountability as well. But we also have an obligation, in my view, as we have throughout the time that I've been here on the board since 2018, to listen to a broad range of voices and to understand how others are viewing the economy and how that should influence our decisions in monetary policy making.
I want to ask you about supervision as well, because the Fed, and I know you've cited this in a speech, you say that 2/3 of banks were deemed unsatisfactory last year. You're reforming the rating system, and you think the problem, I assume, is the grader, not necessarily the test taker here. And that is especially true since Silicon Valley Bank, I believe, in the years leading up to its demise, had a satisfactory rating, and then ultimately, we saw what happened there. Because of these poor ratings, there are many banks in the penalty box, and I'm just curious if you think reforming the rating system would allow more banks to merge and whether you think that's necessary.
So let's start with the rating system. So we made some changes to the large bank rating framework back in 2018 that allowed for one particular category to bring down a bank's grading, which to make it not well managed versus well managed. And when you have three components, two of them are related to their financial condition, and one is related only to their operations and other non-financial factors. It doesn't make sense that we would allow non-financial factors on their own to degrade a bank's financial standing. So the changes that we made balanced that outcome a little bit more. It requires at least a downgrade in one of the liquidity or capital components, in addition to potentially the GNC rating system. And it's important that we do look broadly across all of our ratings frameworks to ensure that we're calibrating them the right way and emphasizing things that are likely to bring a bank down. I think part of the problem with Silicon Valley Bank in particular was that we focused on things that were not financially related. I mean, all of these things were available for us to see if we were looking at the reports. So it's important that we're focusing on financial related factors when we're thinking about the condition of a bank.
Are there areas that you think warrant more regulation? And I ask this because under the current capital framework, we've seen a lot of activity get moved into the non-bank financial sector, into private credit, for example, direct lending. Do you think that warrants more scrutiny, more attention in this new environment?
So in my mind, I'm a banking regulator, and the Federal Reserve oversees the banking system, but also financial stability. So from my perspective, I think expanding the banking perimeter would be a better outcome to allow banks to engage in what were traditional banking activities like mortgages, mortgage servicing, those kinds of activities. I think the risk weightings in the capital framework that we have now have really limited banks' ability to engage in those, especially our smaller banks.